So the question is, why has the value of real estate continued to increase over the past 5 years while interest rates have damn near tripled? Right? That's the question. And this is not something that we're used to seeing because normally we have an inverse relationship between rising interest rates and home prices, right? Whenever interest rates go up, it puts downward pressure on prices for obvious reasons because homes become less affordable, right? So why is this happening? Well, this is symptomatic of a problem with the currency. And it's hard to wrap your head around this. People are having trouble understanding this or seeing this or looking at it or even exploring it because people are not looking at the US dollar as a problematic currency. I mean, we've had the world reserve currency for 81 years, ever since 1944, the Bretton Woods Agreement, right? Americans have had one of the highest standards of living out of any nation in the world for 8 decades, right? And the dollar has been at the forefront of that, and it has been a large reason why that has been so. And so Americans are not used to looking at the dollar with a microscope to understand if there's something else going on. This is more so of a Latin American problem, right? Venezuela, Argentina, the US dollar? Nah. But why are home prices going up while rates are going up? This is symptomatic, again, of a currency problem. And this is what I'm going to explain in this video. So stick around. If you're in real estate, if you own real estate, if you're thinking of purchasing real estate, either for yourself or as an investment or whatnot, this is going to be a very interesting and very important video for you to watch because nobody's talking about this. Nobody's talking about this. And this is called fiscal dominance. And you don't hear this term used in today's society. You hear it very little in the underground. And the people who are talking about this are the real economists. They're the people who are at the forefront, looking at the real data and looking at the real things. You don't hear this in the mainstream media. So just like back in 2013, 14, 15, even 16, even 17, 18, 19, really, you really didn't listen to talks about inflation. Inflation? We're not going to have inflation. We're never going to have inflation. Have been talking about inflation for 20 years. It's never going to come. Well, hello, here it is, right? And this is and nobody was talking about it before, and now in 2020, 2021, 22, everybody was talking about inflation. My grandmother from Cuba called me, was like, "Mijito, inflation." And she was telling me about inflation. So the same exact thing is going to happen with this term fiscal dominance. Okay. And this is what we're going to talk about today. So the simple thing is that basically this scenario that I described earlier is symptomatic with a problem with the currency. And the reality is, and what people are not looking at is the currency. And the reality is that the currency has collapsed. And the value of real estate has actually collapsed in terms of real currency, real money, right? It's gone up in terms of dollar, but it's gone down in terms of gold. It's gone down quite significantly, sharply in terms of gold, and it's gone down quite significantly in terms of Bitcoin. Let me rephrase that. It's collapsed in terms of Bitcoin, right? If you price real estate in gold or Bitcoin over the past 5 to 10 years, the value of real estate has either fallen sharply or entirely collapsed. And so, but of course, if you look at it in terms of dollars, it's risen, doubled, sometimes tripled. So this is the problem. The problem is that people don't realize that there's an issue with the currency. And so what's causing this? Well, what's causing this is very simple. It's the debt. The debt is too high. We have too much debt, right? The debt became a problem. The debt was not a problem until it became a problem, right? Just like you can smoke, you can drink Coca-Cola, you can eat seed oils, you can, not work out or exercise, and you can eat fried foods for 40 or 50 years until it becomes a problem, until you get cancer, right? So inflation was not a problem until it became a problem. The debt was not a problem until it became a problem. Now it's a problem. So this is what is causing this currency debasement. So it's very simple to understand. Let's explore this concept of fiscal dominance, which you will hear a lot more of in the future. So debt to GDP is too high. It's 125%. Okay. US deficit is too high. It's 7% of GDP. US government spending is 25% of GDP. It's a quarter of the economy, ladies and gentlemen. And if you're thinking that the Department of Government Efficiency is going to be able to do anything about that, think again, because remember, the bulk, almost 90%, I think it's 87% of the fiscal spending, US government spending, is obligations, right? We're talking about government obligations, Social Security, Medicare, Medicaid, defense. And let's not forget one of the most important of them all, servicing the interest on the debt. And so those are things that Doge can't do anything about. You know, they can only do something about 10 to 14% of the total income, which is discretionary income. Everything else, they can't really do anything about it. So they're very unlikely to make a real dent in this and not be able to help. I'm sorry. So the key here, the main takeaway is that the deficit problem is not going to be fixed this decade, right? And that means ongoing currency debasement. So let's explore that. So basically, in simple terms, the debt is so high that rising rates are actually stimulative for the economy, which has never been the case before, or at least in my lifetime, or from what I can remember, or from what I have been able to study about history. We've never had a scenario where raising the interest rates or rising interest rates have been stimulative for the economy. It's always been the opposite, obviously. It's lowering rates that stimulates the economy, not when they go up. But what happens in a scenario of fiscal dominance is that actually stimulates the economy because you're blowing up the deficit, you're blowing up the debt every time the rates go up, right? And so what are the ways out of this? And stay with me because you'll understand how this relates to real estate. I'm trying to make a point here. So what are the main ways out of this debt to GDP problem scenario? Number one, you can let rates continue to rise or raise rates, but you need to cut the spending in a significant manner and really, really fast, almost immediately, so that it offsets the interest on the debt or that servicing that debt, right? That interest of that debt. So it needs to be done immediately, and it needs to be done to a significant level where it actually offsets that new debt, you know. And so the only thing that they can cut to do that is government, like the government, the responsibilities of the government, which is like I said earlier, Medicare, Medicaid, Social Security. You know, that's not going to happen by cutting discretionary spending, and those things need to be cut by 25-30%, right? Not by 5%, right? So do you see the president of the United States, the current one, or any future president cutting Social Security, Medicare, Medicaid, defense spending by 25-30% in order for debt to GDP to go back to normal levels? Do you see that happening? I don't think so, right? So that's the number one scenario, the number one way that you can get out of it, right? Allow rates to rise, but cut spending enough and immediately and fast enough where you can offset that difference. Number two, negative real rates. So in other words, the interest on the debt needs to be lower than the rate of inflation so that the real interest rate is actually negative. And this is what has been happening. And more so since 2020, 2021, when we printed 60 to 70% of the dollar that has ever been in circulation. We printed over half of all the dollars that have been in circulation since the beginning of the dollar's existence during the pandemic. Okay, that's why it's more apparent. That's why it's more in your face, right? That's why inflation has run so hot, and that's why this fiscal dominance term is now coming out of the underground, and it's going to become more mainstream as time passes, right? So second scenario, negative real rates. And you can either have negative real rates really, really negative for a short while, or and that's called hyperinflation. And in my opinion, this is not going to happen. This is very pessimistic. I don't see this happening in the US. Or you can have a little bit negative real rates for a long time, right? So, and this is what has been happening. Hello. I mean, the dollar has lost 99% of its purchasing power since its inception. This has been happening for a while already. But the thing is, it's more in your face now because the debt has gotten so big and so unsustainable that it's now become a real problem, like that cancer patient I was talking about earlier. So that's the second way, right? Is that likely to continue? I mean, they've already been doing it for a long time. Why wouldn't it continue? It's the most politically expedient way to, you know, wipe things under the rug, right? To have sustained periods of high to hot inflation for a long time. And this is going to cause a lot of problems. This is not a solution that helps everybody. This is going to be problematic, but for them, for the politicians, for the people who are in power, it's much less problematic because it's more under the rug and people don't really see it as much as these other ways to get out of this problem. So this is the second way, and this is the most likely way that I see that we move forward. And this is called fiscal dominance. Basically, where the fiscal side overwhelms the monetary side. This is fiscal dominance. It's very simple. Second way. Third way is to restructure the debt, right? So we're not going to pay it, we're going to cut it, we're going to make it zero, we're going to, term it out. This is crazy. This is never going to happen, right? Fourth way is a productivity miracle, which has happened before, right? But it's extremely unlikely to happen. I mean, it happened before during the Industrial Revolution. Debt was really, really becoming problematic, and we had the Industrial Revolution, and that offset the debt problem, and that resolved that, and that brought down debt to GDP to almost nothing, right? 20-30%. So that can be a way out of this problem. Nuclear energy, AI. It can happen within the next 3 to 5 years, but it's not likely. I don't see this really coming to save us. So this is the second likeliest scenario, in my opinion. So imagine how likely we are to continue to have negative real rates if this is the second likeliest scenario, which it is very unlikely for this productivity miracle to happen. And then lastly, the fifth way that we can get out of this debt problem is to default on the debt. Simply, the U.S. Treasury declares bankruptcy. Rates are allowed to rise. The stock market's going to crash. The real estate market's going to crash. The price of everything will crash. We'll have a global crisis unlike anything that we've ever seen. And it's going to make the Great Depression look like my grandma's soup. It's really going to make it look like a romantic comedy. So that's not going to happen. That's not politically expedient. I don't see our politicians allowing that to happen. So which of these 5 scenarios is likeliest to happen or to continue happening? Negative real rates, fiscal dominance, high or hot inflation for long periods of time until the debt is effectively basically defaulted on through currency debasement or through high inflation. So welcome to Fiscal Dominance, ladies and gentlemen. And so I'm going to give you, how does this relate to real estate? And I'm going to close it up by talking about giving you a quick national market update on the real estate market. And then, talking about how that relates to real estate. So the median sale price for a home right now in the United States is $427,670. A year ago, it was $402,000. That's up 6.3%, all while mortgage rates are back above 7%, okay? Now, and I'm talking about the national market, the median national market. If somebody watches this video and sends me a message, but the price of my condo in Hollywood is down by 25% because insurance has doubled. Yes, that is happening in some markets, in some buildings, in some areas. Real estate there's not one real estate market. There are thousands and thousands of real estate markets. Real estate is hyperlocal. It's not even state or city, right? So I'm talking about a national average here. So bear with me, keep that in mind. So median sale price has gone up 6.3% year over year 5 years ago, the median price was $296,000. Okay, in the past 5 years, it's up 44%, which is insane if you think about that. Supply, right? Let's talk about supply. We have 1.5 million homes listed for sale in the United States of America today. That's 3 months of supply, 49 median days on the market. That's considered a seller's market, right? 6 to 7 months is normal. That's up 9.1% year over year. So supply is up. Even though it's still considered a seller's market, supply is up, which is great. And supply has been going up. But the question is it going to go up, or is it going up fast enough to cause downward pressure on prices? I don't think so. Not really. There's a lot of factors why I think that, and I'm not going to get into that with this video. I'll make a separate video talking about that. But the inventory is going up, but it's not going up fast enough to cause downward pressure on prices. And if you look at what inventory nationally was 5 years ago, pre-pandemic, it was 1.8 million homes for sale, right? So we're still 300,000 homes. We have 300,000 homes less for sale today than we had 5 years ago on a national average. Again, I'm not going to get into that because that's a topic in and of itself. But I don't think it's rising fast enough to put downward pressure on prices, and I don't think it will rise fast enough in the future, at least not in the short-term future, to cause downward pressure on prices. So that's supply on a national level. Then basically for the stats, 24.2% of homes are still selling above list price. That's a quarter of homes. In 2022, it was 40 to 60%. It was insane. We're back to normal levels. But what that means is that a quarter of homes are still selling above list price. So if you find a good home today for a good price, don't lowball it. Don't try to bid on the home, because you might lose it, right? So be realistic. And a good price home today is very hard to find. So be realistic, please. And then what are the price forecasts? So there are 21 renowned institutions that give their real estate price forecast on a national level every year. Goldman Sachs, Zillow, Bank of America, Freddie Mac, et cetera, et cetera. 19 of these 21 institutions are projecting home prices to increase on a national level, and 2 are projecting home prices to decrease. There's one, I forget which one it is, that is projecting a minus 0.4% decrease, and there's another one that's projecting home prices to decrease 2.2%. The other 19 institutions are projecting an increase between 1.9 and 5.7%. So the average, if you take the 21 institutions, the average forecast is an increase of 2.9% on a national average for the median price of homes in the United States of America. So this is kind of like a snapshot of what's happening on a national level. So to close, as it relates to fiscal dominance, what can you do? How can you protect yourself from a fiscal dominance scenario, right? From an ongoing high inflationary environment that, the main theme is currency debasement. So the number one thing is get out of the currency in which the debt is priced in, right? So Bitcoin in your possession, not on a currency exchange with God knows what security in God knows what country, right? In your possession, in a wallet that's in your physical possession. Or gold, same, not paper gold, not gold in the stock market, not gold in the bank, but in your physical possession, either in your home or in a third party secure safe. And basically everything, any currency that is accepted on a global level that doesn't have counterparty risk. That's number one. Number two, you can look at commodities, you can look at the stock market, and obviously you can look at real estate, right? Anything that cannot be duplicated, that has real world value and usage. This is what you want to purchase and own during a fiscal dominance scenario, right? High inflation, high currency debasement. So this is why I love real estate, and this is why I'm making this video, so people can understand that there is a strong case for real estate moving forward. Not all real estate, right? Not all real estate. There's a case for single family replacement real estate, right? If you own a studio that's 300 square feet in the core of Miami, that's located in a building that has 700 units that allows short-term rentals, This is not a good purchase in a fiscal environment in a fiscal environment scenario. Why? Because remember, fiscal environment is highly unstable. Fiscal dominant scenario is highly unstable. So anything can happen in the short term that can cause, deflation. So we can have a deflationary event in the US economy that can it's going to last for a very short time, because again, remember, as that debt starts to spiral, they need to come in with fresh money, right? So that things don't get out of control. So they cannot allow a deflationary event for a long time, because it will get out of control. They're not going to allow the banks to fail. They're not going to allow any real massive deflationary event to happen, because the debt will spiral. So, but we can have something in the short term where for 3 to 6 months, prices can come down, the stock market can come down. Things like this can happen. So you have to purchase real estate that is, waterfront, luxury, branded condos that are bigger than 2,000 square feet, single family, that is close to the core of Miami, close to the best schools, homes in Coral Gables, Coconut Grove, Pinecrest, South Miami, etc. And these condos, such as the St. Regis residences in Brickell, the Four Seasons private residences in Coconut Grove, the residences at Mandarin Oriental in Brickell Key, the Waldorf Astoria in downtown Miami, you have to purchase the anything that is as close as possible to a trophy real estate. Better if it's a single family home, but I understand that some people don't want to purchase a single family home in Miami because they don't live here the whole year, and so they want something that's less, it's easier to maintain or to manage. I understand that. But if you buy a condo, it has to be waterfront. If it's not waterfront, it has to be something really unique, preferably waterfront. If it's waterfront, it has to be low density, right? Less than 250, 300 units, and large units. If you have a condo where 30, 40, 50% of the units are studios and one bedrooms, you do not want to, that's not a smart purchase in a fiscal environment, in a fiscal dominant environment. So this is my case for real estate in Miami. This is my case for single family replacement real estate in Miami. And I think it's a very good purchase for everything that I just discussed. I hope this made this fiscal dominant term a little bit more clear for you. And I hope you understand now why home prices have been going up, even though rates have been going up. And this is going to continue to happen, in my humble opinion. Anyways, this is Danette, and I'll see you in the next video.